Thank you very much, Greg, for your kind introduction. Thank you very much to the people of RBC who would allow us to come and speak before the group. And thank you very, very much for the Tridec group who would allow us to come as well and talk to you today. It is my pleasure to share with you my company, Federated Investors' views on the economy and then what we think that means for investing in the market. We share a short-term, intermediate, and long-term outlook on the market. And as the title of my presentation will show, we suggest dividends for the short, intermediate, and long term. And I will explain to you why. I like to start my discussion, though, by sharing where we are at the moment. And I think on Easter time, we're not quite ready to close out the day. We're about flat on this day. When we look at the stock market, it's working. When we look at the stock market, we watch the S&P 500 index as an index that measures a broad universe of stocks across our country. Today, the S&P was about flat, closing at about S&P 1494. Do you see someone approaching the steps? It's okay, I don't mind standing back here. As you were. Do you think I can move now? Hello? How about now? Thank you very much. We were about flat on the day, we're closing, it looks like, in and around S&P 1494. What is 1494? And by the way, during this day, the stock market traded above S&P 1500 for the first time since December of 2007. We're at a 5-year high. What is S&P 1494? Well, it's more than doubled up off the bottom. Don't know how closely you follow the stock market, but the stock market at its lows, at the very worst in the bear market, which was March of 2009, was at S&P 666, too easy for me to remember, because it's the number we associate with the devil, right? It's the number, and it reminds us that those were devilish times. At that time, we had a complete freezing up of financial markets around the world. Many people feared in the United States and around the world that we were going into the next Great Depression. At that time, our leaders and those around the world and our central bankers said, we will not have another depression. And so they went about basically spending trillions and trillions of dollars that we don't have. That has been good enough to get us an economic advance that has more than doubled up off the lows in the S&P 500. My company, Federated Investors, has been bullish on stocks since November of 2008. We were a little bit early. We've been bullish all the way through this time period. And as we stand today, opening this year at S&P 1426, we think we could reach upwards of 1,600 or better before the year is out. Potentially another very good year. And so as I go on to describe to you why we feel this way on a short-term basis and how we think one ought to invest, we think that and I can tell you this, as someone who travels the country 4 and 5 days a week and has done so for the last 4 years or so, I have met so many of my fellow American investors who has thought that the best days of America are behind us, who has thought that we could never have a bull run again, and honestly has missed the vast majority of this rally that we have seen. We think that we will continue to do well, but the best parts of our advance are behind us. If you're bullish today, at the level the market is today, after more than doubling up off the lows, it's because you are bullish that we will begin to pay more for earnings. People who are negative say, you tell me one positive thing, I'll tell you one positive thing. Record corporate earnings across a broad array of countries in America. And people tell me about what they worry about all the time. And I will say, you know, I don't diminish the importance of anything you're worried about. I worry too. But at the end of it all, it is simply a question of what are corporate earnings, and then what am I willing to pay for it? That's it. What are corporate earnings? They're at an all-time record high. That's good news. Then what am I willing to pay for it? And historically, what I would be willing to pay for stocks, for earnings of stocks, was related to inflation. And the ideal situation is when inflation is low and positive, which is where we are right now. And so we have never paid up what we normally would pay for earnings all the way through this whole bull run, which gives comfort to the bull. But as we make our way through this year, and as you know, we make our way through the tough negotiations that need to go on still in Washington, D.C., we see leading economic indicators in our country, just reported today, still up a little bit. They seem to be peaking. Within the next, I would argue, 12 to 18 months, we will commence a recession. And so we don't want to be too greedy. We have reached 1,500 already this year. We could get towards 1,600, but when I remember that the all-time record high in the stock market, which was also in December of 07, S&P 1565, prior to that, S&P 1560 in March of 2000, do I really think we're going to pierce through that on the upside when this economic advance is old by historical standards, and I know of all the problems that we have to face? So my message to you is basically one of malaise. Not the best, not the worst, malaise. A sideways environment, and we know how to invest in a sideways environment, and that is dividend-paying stocks. So now I go into my slides, and I show you a chart that we keep updating constantly, and it shows you all the major regions of the world: United States, Europe, Japan, Latin America, and Asia Pacific. What we show you is how these areas have grown in the last 3 years and what we think for this year. What you can see, first of all, is the negative year, that big year down in 2009, what we called the Great Recession, at which time our leaders said, no, we will not have a Great Recession. They pushed a lot of monetary and fiscal stimulus out, and we were able to have a recovery. But you can see how weak is this economic growth. Economic growth around our country has been so weak in this cycle that many of our fellow Americans believe we're still in a recession, when our leaders in D.C. who calculate these matters tell us, no, we exited the recession in the middle of 2009. But this has been a very weak economic growth. We think we'll still be positive this year, but of lower growth. And if you think about it, that's with all that stimulus that was applied to us. Here's another way of looking at it. This looks at history, which we do a lot in our work. And it says, how does an economy generally go into a recession and then come out? That is the dotted line on the top. Generally, you fall into recession, you get easy fiscal and monetary policy, and then you can recover and move out. But the recovery that we've been experiencing this time around is this blue line on the bottom. Very, very weak by historical standards. And when we look at the short term, we say all roads lead to jobs. And we look at the job market and the situation. What we're showing you here is the same sort of a picture. It shows you all the cycles going back to the early 1950s, how jobs are lost into recession, and then how they come back in an economic recovery. Once again, the bottom line, that bottom blue line, is the advancement that we're seeing today in this recovery in terms of jobs. The job recovery that we have seen this time around has been the weakest since the Great Depression. We're watching it very, very closely. And why has it been so weak? There's been a lot of uncertainty. A vast majority of it has to do with the behavior of small businesses. Maybe some of you or many of you are small business people. We get a lot of information from the small business community and some of the most interesting people that I have met as I have traveled. Every month we take a gauge, or government does take a gauge of how they feel. The NFIB Small Business Optimism Index. Remember, they hire 70% of us. And every single month since the recovery has begun, when they ask them how they feel, their level of optimism is commensurate with historical lows in the middle of a recession. Why? What is your problem, small business person? And they say the same thing each and every month. I'm worried about my sales because we're small businesses. Many can't get the benefit of the export boom that came with a weaker U.S. dollar. I have taxes and I have government regulations. And now I can report to you that they're not happy about the cost of health care either. So they say, so I'm not hiring. What would cause you to hire a small business person? And their response consistently is, I want a permanent tax cut. That's been a problem in terms of the recovery, as has been the problem with public sector employees, as you know. Around our country, many, many states have cut back dramatically their public sector employees. Most states and local municipalities, unlike our federal government, have to balance their budgets. And in the throes of the recession, they had to cut services and raise taxes, and cutting included laying off a lot of public service employees. This, as well as the decline in jobs in the construction area, these three things have come together to give us a very weak recovery. Now, we watch every month on the first Friday to find out what the employment situation looks like. And what we found in the most recent one was what they called a solid report, a pretty good report. We added 155,000 jobs, and that's good news until you look at the components. Because out of 155,000 new jobs, 93,000 of them were in the low-paying healthcare and hospitality areas. So this is the kind of a situation that we have now, reminding us that as we see economic growth continue and we see a continued trajectory up in jobs, it is very, very modest indeed. So we talk about the stock market, and I talk about all of the concerns, and I tell you many times in these last several years, I would describe how we're bullish at our company, and people would listen politely and yes, 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 but I'm not going to do anything about it because times are really bad. And I've had people come up to me after presentation and say, I will not buy stocks until the unemployment situation gets much better. And what they fail to realize is that the stock market is a forecasting mechanism. And whatever the price of the stock market is today is not based on what we know today, but based on our view of the future. It is a question of what is priced in. That's what we have to ask ourselves. So you look at the unemployment situation, just one of many factors. History says that the higher the unemployment rate, the higher is the next 12 months return in the stock market, simply because the stock market is a forecasting mechanism, and it reasons that if the employment situation is poor, our leaders in D.C. who want to get elected or re-elected will do what they can to jumpstart that. And that usually is bullish for the economy and the markets. What we show you here is a chart that looks at the price we have paid for earnings, the PE multiple, on trailing earnings going all the way back to 1900. Various charts that I show you today have bars that indicate recession in our country's history. We look at what I'm willing to pay for earnings, and we are below the average today. If you're bullish today, after more than doubling up off the lows, you will believe that we will finally pay the average price to earnings multiple that we paid historically for earnings, which are, as I said, at an all-time record high. And if all you do is pay what you always did at this level of inflation, you would be at 1,660 today instead of trying to get to S&P 1,500. What we need for that to occur is more confidence in our country, and I would argue that takes us right back to looking at the situation over in D.C., which is something that's been of concern. D.C. and, of course, Europe, although that's a little bit more on the back burner. But that gives the bulls some cushion. I will pass up some of these charts in the interest of time and not lose the thrust of my argument. This is the fiscal cliff that everyone's been talking about. You know, it's so much fun for me because I talk to groups all the time all over the country, and for about 6 months last year, I'd say, who knows what the fiscal cliff is? Nobody knows until early December. Now nobody wants to hear about it again. They keep hearing about it constantly. What is the fiscal cliff? The fiscal cliff would have been, if it were allowed to occur, would have been a compilation of huge cuts in spending and the biggest tax hike in our country's history. And nobody believed that the full brunt of the fiscal cliff would occur because the economy has been so weak, you see. The full fiscal cliff, if it were allowed to occur, would have cut 4% off of an economy that's only growing at 2% and would have thrown us immediately into recession. Well, we kicked that can down the road a little bit. That's another phrase we love to use in our business, kicking the can down the road. By the way, in case I forget, we'll run out of time. to tell you this. The stock market, people say, well, the market would love it if we could do a grand bargain. You know, we need to figure out some way to get these deficits under control. The grand bargain. And I don't agree with that, because the grand bargain will be a coupling of tax hikes, which are not pro-growth. When money comes out of our pockets to pay taxes, it's not pro-growth, and entitlement cuts, also not pro-growth. The grand bargain would be us taking our medicine, if you will. And the stock market doesn't want to talk about that. The stock market wants us to kick the can down the road. That's why we cheered earlier, or I should say at the end of last year, when the fiscal cliff was pushed off. We traded up earlier this week, and to include today, when the Republicans said we will allow the debt ceiling, which is the current problem, to rise up until May. And if they allow it to rise up until May, they could do accounting gimmicks at that time, so you don't have to deal it again until August. That's what we call kicking the can down the road, and that's all the market wants. Or a grand bargain that's very heavily back-end loaded to the back 10. But regardless, we all know we have a debt problem and a deficit problem, and the piper must be paid. And when he is paid, that's going to be something the market won't like too much. So here we are growing about 2% a year. We have to worry about the sequestration, that is the forced cuts and big cuts in defense spending that are expected to occur in March 1. We have the payroll tax that went away, other tax increases that hit the wealthier among us, and that looks to be about a 2% hit to an economy that's only growing at 2%, which means we will be uncomfortably close to the next recession. And many people fear that next recession because we know that recessions have stock markets going down. I would argue, what difference does it make if we're growing at a very anemic 1% or 1.5% or contracting at that much? It's all very anemic. It is a period of malaise, and it could be a lot worse. Why do I feel that we shouldn't worry about a recession? Recessions feature stocks going down, and I'm telling you, we like stocks. We love dividend-paying stocks. Why would I say that? Because when a recession occurs, which it obviously will sometime in the future, it is very likely to be mild. And people don't want to think about that because the last one was very harsh. Why do I say that? For two reasons. One, we have record corporate profits today, or near record. Historically, in a recession, profits fall, sometimes fairly dramatically, as they did in the last one, and profit margins fall. I will argue that this next recession will be milder than feared, as profit margins won't fall as much as feared for the simple reason of why they're so high. Why are they so high? Reason number one, a weak U.S. dollar. Now, that doesn't sound good to have a weak U.S. dollar, but as against other currencies, if you don't debauch the currency, a weak U.S. dollar, all else equal, is great news for any company in America that exports its goods, because our goods look cheap versus others to those outside of our country. And in fact, we have enjoyed an export boom in this country in these last several years. That's good news. Now, it is in Ben Bernanke's interest to keep the value of the dollar low. He wants to keep the value of the dollar low because he knows, as we all do, that every day and every moment the debt grows and grows and grows and grows, and he would like to pay off the debt with cheaper dollars. And he has said, as you know, I will buy securities, Treasury securities. By the way, the Fed balance sheet today owns more Treasury securities than Japan and China combined. He said, I will continue on buying Treasuries and mortgage-backed securities, which helps the housing market and yields. And I will buy them basically to infinity and beyond until the unemployment rate gets to be a very low number. Now, here I am. I really appreciate the kind introduction. Every time I hear the introduction, I think, boy, that does sound like I'm pretty smart, doesn't it? I love that. I want you to think I'm smart. But every now and then, when I'm all by myself, I panic a little bit. I think of a question. What if somebody asks this question and I don't know the answer to that question? Stop it, Linda. You're by yourself. You don't need to panic. And I look it up. And it occurred to me not that long ago, I have to admit, in my defense, I'm an equity girl and not a bond girl. I'm thinking, where does Ben Bernanke get the money to buy all these securities to infinity and beyond? So I look on Google. You really want to think I'm stupid? I discovered Google like 3 years ago. Isn't that fabulous? Do you love Google? I was telling my girlfriend, I'll sit in the airport and I'll look up, so how old is Brad Pitt? Doesn't matter, obviously, but how old is, Demi Moore? I just do it, just caught up on Google. And what I found was, you know where he's getting all the money? Thin air. Thin air. Or to be precise, a computer entry. And when he describes it, he'll say, this is nothing more than another form of easing. Not to worry, we'll be able to unwind it. How do you know that, Ben? When this has never been done before, this is unprecedented, how do you know you can unwind it? Meanwhile, over in Europe, Mario Draghi, which really got things going better last year, said, I am going to buy securities until infinity, until I'm satisfied things are much better. Not to be outdone, Japan, for the first time in decades and decades, said, well, then we're going to do it too. That what we have today is a race to the bottom in terms of the value of currency. It's actually a little bit of a blessing. I don't know how the story ends, but it will prevent us from debauching our dollar sooner if we're all trying to debauch our currencies, if you will. And that is good news for corporate earnings. With the value of the US dollar low, it is good news for any company that exports. That's reason number one for profit margins being so high. Reason number two is that interest rates are very low, as you know. Interest rates are also being low, are also in the interest of Ben Bernanke, because Ben Bernanke sees our debt growing and growing and growing, and the interest expense that we pay to service this debt growing and growing. And he wants to keep those treasury yields low. The 10-year treasury today, 1.8% give or take. If it went up to a fair value, if it went up to 3%, that $1 trillion deficit would balloon, and he knows it. It is in his interest to keep on buying these securities, and that is great news for corporate profits. And then finally, corporate profits in a broad array of industries have benefited from technological advances. That, which is very good news for corporate profits, unfortunately, has prevented many people from getting their jobs back after the recession, and that is a problem. But as an investor who's looking at profit margins, I don't think we need to fear them falling too much. That's one reason why the recession should be mild. Reason number two is because historically recessions in our country always came because we had excesses that need to be worked off. What is our excess today? Is it housing? Of course not. Housing was the excess the last time around. It's getting off its feet now, and that's good, but it came crashing down to get off its feet. It's not housing. What about businesses? Do they have excesses to work off? No. In fact, they're hoarding their cash. They have record cash on the balance sheet. They have spent way less than they normally would on capital expenditures. Their inventories are very tight. And how are they going to lay us off in the next recession when they scarcely hired any of us back after the last one? So they don't have a lot of excesses. When you look at us, we as consumers, same thing. We are repairing our balance sheets. Our balance sheets and our debt service on our balance sheets has improved to the extent that it was before we ever went into the recession. The frugal American consumer. That's what this chart shows. This chart says tell me, as a share of the size of the economy, what is our spending on housing and automobiles? And you can see it goes back to the 40s. Look how it came crashing down to a near record low. We are working on a pent-up demand. The next recession is arguably going to be mild. So we look at a normal cycle in our country's history. That's a normal cycle. You come out of recession, you go into expansion, you peak out, and leading economic indicators begin to roll, and I would argue we're peaking out now. And if I'm right, over the next 6 to 8 months or so, the leading economic indicators will start to roll over. And what happens to the stock market when they do? It doesn't go down, it goes sideways. Sideways equals malaise. And that to us means the dividend strategy. This is what Ben Bernanke's up against. The velocity of money has come crashing down. He says, I'm going to 0% Fed funds, an emergency level back in December of 08. It's still there today. Where's the emergency today? 0% Fed funds. I'm going to buy, basically pushing money out there. But if the banks don't lend it because their standards are too high versus what people can can meet, or because companies, small businesses maybe, or people don't go to the bank, don't feel like they want to borrow, don't feel that spirit about them, then all that money he pushed out there goes nowhere. The velocity of money comes crashing down. It sits in basically these banks, and if it doesn't make its way out to the economy, well, it always makes its way out to the markets. If you've ever heard the adage, don't fight the Fed, this is don't fight the Fed, bold and an exclamation, if he says, I'm going to print to infinity and beyond. So we wouldn't want to get too bearish. I see my clock is ticking, and I'll be very careful to behave myself. There's so much to tell. There's just so much to tell. And I've come so far. I've come from Pittsburgh, you know. Much nicer weather here. This shows you the bubble that was housing in red, overlaid on top of a composite of other bubbles in our world's history. Bubbles behave the same way. They come to a peak, they come crashing down, they do a bounce, and then what? Historically, they'll go sideways for a spell. This argues that unless you're someone who's going to buy a home for rent, the idea of buying a home for investment, probably not a good idea for still a number of years. Just a couple of charts on housing that I'll pass up. On a short-term basis, we have said we're bullish. We think we can still eke out some more gains this year, but sometime during this year, maybe the back end of this year, depending a lot on DC, we may have to start to price in a recession, which should be mild. I should then not fear the recession. I shouldn't get too excited about the upside, though. I should not be greedy, and I love my dividends. Then we move to the intermediate term time frame, which will feature our leaders working on the debt, because they're going to have to. You can't keep letting the debt grow and the debt service grow and keep raising and raising the debt ceiling without really getting hit by the rating agencies. And someday, that 1.8% 10-year is going to move up to 2 or 3. And if you're holding the 10-year Treasury at that time, you won't like that experience at all. Something has to happen. I have a few fun charts to show you about the pickle that we're in. This is my first one. I call it a once-in-a-lifetime surge in government spending. It looks at federal government spending as a share of the size of the economy going back to the 1930s, and it shows the spike at the time of the war effort, which after the war was done, they could rein back in. What we see now, though, is structural in nature, which means it can't come down in an economic recovery. So what's going on? I love this chart, because this chart is my answer to the many fellow Americans that I have met that said, I'm so disgusted. The best days of America are behind us. We'll never get out of the debt. The debt situation at this moment is not terrible. This is where we are. This chart goes all the way back to the 1700s. This is where we are right now. We didn't get our debt downgrade because of where we are. We got it because of where we're headed based on policy. Which brings me to the elephant in the room. The elephant in the room is me and my fellow baby boomers. You can always tell the guys because they don't color their hair. I'm going on Saturday, actually. I'm really, really hoping nobody gets too close. They never counted on us, you see. They never counted on 76 million people, and if you're 55 years old today, doctors of aging will say that you can expect to live into your 90s. Well, this is going to be very expensive, and the math just doesn't work. And so, if you look at the big pieces of the that previous chart, was the pie of what our federal government spends money on. If you look at the big entitlements, Social Security, Medicare, Medicaid, you add in defense and interest on the national debt, these 5 pieces of the pie are 83% of the pie. And if any bipartisan group refuses to discuss the entitlements, they may as well not even have the meeting. Because this is where the big problem is. And this is what the bipartisan Congressional Budget Office has said from where we are. Look at the trajectory of all of those. Look at the interest expense on the bottom. Isn't that remarkable how that's going up? Because of the debt continuing to grow. That assumes a 2% 10-year, which will not be the case. We cannot afford this, and now we have health care for everyone. Not to get into a political discussion. I know where I am. But we can be friends. Fortunately, there's no time. All I want to say to you about this is, that anyone who thinks that adding 34 million people to the ranks of covered health care is somehow going to save money, I will argue not. And it is going to be very expensive. Ooh. Sorry, I got carried away there. Italian, I'm Italian. I have no business showing you this chart at all. It's quite dated. It's dated back to 2008. But I think it says a very powerful statement. It looks at the share of the economy in various countries that are being spent on health care. We're the big one at the far end. That was in 2008, and we're only now starting to get going. Where every day for the next 18 years, every single day, 10,000 more of us join the ranks of Social Security and Medicare. So it is going to be expensive. I don't have time to show you my next several charts, which basically say the following. Everybody knows we have a spending problem. Well, I shouldn't say that. Some people think we have a spending problem. But we, baby boomers, we just got our entitlements. We don't have to give them back. And no politician, I don't care what side of the aisle you're on, will stand before the American public and say, I promise if you hire me, I will cut your entitlements and raise your taxes. They won't say that. And so history is very clear. We have 200 years of history that is very clear. We're not the first country in a predicament like this. The best way to go at the problem is to cut spending. But if you refuse to cut spending, there's only one other thing to do, and that is to raise taxes. We raised them a little bit at the beginning of this year, but it's not going to be nearly enough money, as you know. We need to have taxes go up across the board. We need to have a value-added tax, a tax on virtually every good or service that you could buy. We're the last developed country not to have it. We need to have this, and this current administration has suggested such at the beginning of 2009. I will argue that when they do this, lots of money will come into the coffers. Lots of money, which, if applied to the debt, will do wonders. If I may ask you a question, who in this group believes that when they raise the taxes, they will apply to the debt? Anyone? Anyone believe that? Because I've been asking this question for the last 2 years. I've gotten 5 yeses across the country. 5 yeses and me. How could I be so naive? You know, they always spend it. And this is my argument. Excuse me. For the biggest worry of all, the value of the United States dollar, I will argue the United States dollar on a trade-weighted basis has in recent years come down to touch important support levels. If they fall through on the downside, we will see a lot of inflation. Unemployment will stay high, and nothing good will happen to our debt. And this is something our leaders understand. I will argue that for no reason, but backs against the wall, they will do what they must and will apply towards the debt. In the intermediate term, though, as we work out our problems, I think we'll look something like Japan. And this is a picture of Japan's stock market since the mid-1970s. If you bought the Japanese stock market in the early 70s and you held on until today, you made hardly any money at all. That was our sideways, a period that we had in our country from 1969 until 1983. In 1983, we started our brand new buy and hold secular bull run that took us up till 2000, and we've been in a secular bear ever since. Sideways patterns argue again for the dividend-paying strategy. I show you back again the Japanese investor back in the 1970s. If he bought the Nikkei, he made no money through now. If he bought high dividend-paying stocks of quality, he made an annualized return of about 9%. I think you're going to like your dividends in the sideways pattern. I think I will finish on this chart here and describe to you our view of the long term. Because the long term in our country could feature the next buy and hold secular bull. But the elephant in the room will remain. And because of no reason but our demographics and how expensive that will be, I will argue that our debt will keep growing. Perhaps they can retard the trajectory some, but the debt will keep growing. And we are moving, if we're not already in a situation that looks much like Europe. It's not the end of the world, but what it means to us is that if you want to invest for growth going forward, it will be emerging markets. In the meantime, here in the United States, we ask the question on this chart. If you buy a stock decade by decade in this country, how do you get paid by owning the stock? And there are only 3 ways to do so. The first way is with the original dividend. That's the dark green part of that bar. The second part is the growth of the dividend, which, of course, you can't get unless you bought the dividend-paying stock. And then finally, the mustard color is what we call PE multiple expansion. That is, in other words, I buy stocks because they go up, which is what most investors unfortunately saw. Most investors today in America got involved back in the 80s and the 90s. In the 80s and the 90s, that featured heavily in total returns. I like to call those the Madonna years. Those years featured a lot of fake earnings too. And so we lament the last 12 years that we lost. And we long for that sort of a period again. And I will argue that is not what we're going to see going forward, for the simple reason that our economic growth rates, remember, we only got 2% after throwing trillions of dollars at the situation, and we're not going to be able to do that anymore. We only got very weak economic growth. So that the future, unlike the 80s and the 90s, looks like you will have weak economic growth. So weak that they won't be strong enough, nor will they last long enough to get us the animal spirits that say, I buy stocks because they go up. And that if you can't see the PE multiple expansion because of animal spirits, the only other way to get it is with interest rates coming down, which they cannot do. They're already on the floor. Which says to us that the future will look like the decades prior to the 80s. Prior to the 80s, we were in a recession about half the time in our country. Prior to the 80s, the S&P 500 gave a 4% dividend yield versus a 2% today. Prior to the 80s, the average payout ratio on earnings of the dividend was 55 cents on the dollar. Today, it's near record low 30 cents. Would excuse me, corporate America. I know you have record profits. I know you have record cash on the balance sheets, and we want to be paid. And I will argue that going forward, not just for the reason of demographics, which again, we're supposed to be getting more income in our portfolios, that next younger group, that Generation X was born between 64 and 84, he is more conservative than we are, because this is all he's seen since he started to invest. The notion of the dividend strategy has legs and legs. I finish my comments here, if I may, remembering Microsoft, somewhere in this vicinity, right, Microsoft? Microsoft was the poster child back in the 80s and the 90s of the coolest company in America. We don't do dividends. We're a growth company, right? So here I was in some city, in some state, in some hotel room, I haven't a clue, about a year, maybe now over a year ago. And there was Jim Cramer on CNBC, if you watch CNBC. And he was reporting to us, today Microsoft has raised their dividend by 25%. And he said, well, I guess now they're a utility. Well, my ears went up. That's gold, Jerry, if you're a Seinfeld fan. That's gold. I have to tell people that. Because we love utilities. We love the stability of the income and that growth. Now, you fast forward to today. Well, maybe not today. Yesterday, the coolest company in the whole wide world, Apple. My hero is Steve Jobs. May he rest. He thought dividends were a big fat joke, and now they're paying a dividend today. And my final sentence to you, and I thank you very, very much again for the kind invitation to come and speak with you this day. Do you wish you had invested in Apple stock back at the original IPO? Back in 1980, if you'd have bought Apple stock, and you would have held on to it to the end of last year, you would have made a lot of money. But if I bought Philip Morris on the same day, I would have beat you by about 3% a year. That is the power of the dividend. So I thank you very, very much. I wish you all the best. God bless you. Thank you.